G'day everyone, Jackson Millan, the Wealth Mentor,
G'day, Sam Panetta. How's everyone going?
and we're here for another episode of Ask Aureus Anything, our weekly live Q&A. And mate, who even are you? It's been a couple of weeks. Where have you been?
Mate, I've been on daddy duties.
Daddy
I've been
duties.
taking care of my daughter. Been spent a bit of time in the hospital, a bit of time at home. It's been good. It's been excellent.
Has been the experience so far, mate, being a father?
It's the best, mate. Yeah, like people tell you, wait until you have kids, your life changes and all that, but not until you have kids do you actually realise, like the feeling you get and how much it changes you. But it's been phenomenal. I haven't had much sleep. You look at my eyes.
You
My
look
eyes
dead,
are
mate.
half shut.
You're good.
I've had hardly any sleep, but it's been great.
That's good,
I'm
mate.
gonna have 10 more.
10 more kids,
Yeah.
mate. You have all the kids for me. I'll have kids vicariously through you. All right, everyone. So you all know the drill. Our weekly Q&A where we answer your questions either live. We prioritise all your live questions, but otherwise we've received a ton of questions throughout the week. That typically, given that we're getting close to tax time, a lot of it is around how to optimise your tax. So we'll be going through some of that. But of course, if you've got questions, make sure you post them up, and we'll be sure to answer them live.
Yeah, so this is our 21st episode, mate. So we're getting stuck into these. They're gaining a lot of traction now that we took them, especially out of the Wealth Mentor community. It's been like that a while now. We got them on the Aureus financial page. Look, it's been good for you guys who are there, who are watching this live. Don't be shy, like, share, comment. If you guys have questions that you want to ask, don't be shy. Ask them. We'll answer them. I'm certain you guys have questions because every week people jump offline and they message us directly and they say, hey, can you answer this question or can you answer that question? They have to wait until the following week. You know what I mean? So don't be shy. Roy DeRazza, if you're watching, we've still got your signed copy of the book here, mate. Jackson signed you a copy of the book.
It's collecting dust.
I don't know what we're going to do. So if you're here, mate, you need to come and get your book, Mr. Rocco.
Now, everyone, we've actually got a bit of a new kit. As you can see, we've got our fancy little lapel mics here. Let us know if you can hear us loud and clear, or if Sam is a little bit too loud, more than clear, and we'll adjust accordingly. We're trying to be a little bit more professional, aren't we, Sam?
Yeah, we get a look. A lot of people say to us that the sound isn't too great in what we're doing. We're finance guys. I don't know the first thing about
We're not audio
sound.
engineers.
So Jackson jumps on eBay and he buys stuff like this. So hopefully it sounds better. So if anyone here is who's watching is a regular viewer, then let us know if we sound better or worse. Don't worry about our nasally voices. That's because we're half crook.
Yeah.
But is the quality of the sound better? That's what we want to know. So Jackson, we're going to away some prizes.
We're going to give away our weekly prize.
Who's our winner this week, mate?
Now, just for those of you who this is maybe the first time, we have a community, the Wealth Mentor community, a free community where we have VIP insights, regular insights, and we also have a weekly giveaway for the contributor of the week. So this week was actually Julian Vanderwall, a good friend of mine, very nice guy, runs a fantastic business called Spartan Alliance. So Julian's been a great contributor for the last few weeks and had to give him the prize this week. So Julian, you get a signed copy of my book. I'll post it out to you to beautiful Adelaide. And we'll also give you a strategy session to talk about your personal wealth and how we can help you get to where you need to go. Maybe a new track bike is in order, mate. So let's see if we can help that come to reality.
All right, excellent stuff. So before we get stuck into the questions, it's a legal jargon, general advice warning. So everything you hear today is general advice only. It's not specific advice. So before you go away and action anything that we talk about, you need to go away and you need to get specific, tailored advice to your situation. Don't go winging it on anything we say. So let's get stuck into it, mate. And if you guys are watching, if you have questions, make sure you comment. We've got a bunch that have come through over the past week that we're going to go through, but any that come through live, we're going to answer them as soon as we can. So do not be shy for those eyes that are watching.
Exactly right. So let's dive right in. So a great question was, how much money should I keep for an emergency fund? And it's a question I got today by one of the guys in our team, actually. So he wanted to work out essentially how much he should have in his bank as an emergency fund. And look, this differs from person to person and depending on your particular financial situation and also your obligations. But typically a good rule of thumb is working towards having about 3 months of your living expenses as an emergency fund. Now, depending on your situation, that number can vary. But what we found in our experience is that for most people, that number tends to float between $10,000 and $20,000 as an emergency fund. Now, if you're a business owner, we typically need to ensure that we have an emergency fund both personally and also in your business. Because what I've seen is far too often businesses fall into the trap of running really lean, not having enough savings there to, I guess, weather the storm if there are any, I guess, things that catch them off guard. And therefore, they run the risk of essentially becoming illiquid or insolvent and essentially having to close their business. So it's very, very important to have an emergency fund. Isn't that right, Sam?
Yeah, I think it is, mate. I like to keep a larger buffer as an emergency fund. I keep it there for strategic purposes as well. So not only for an emergency, but if an opportunity comes up and you can move quickly because you've got the cash available. And we've seen that when lending was a little bit looser. We saw a lot of people that used to, their value of the property would go up. They'd borrow against the new value of the property. They'd get a couple $100,000 cash out of the property. They'd just sit it in a bank account. They'll pay no interest on it, sit in an offset account, and they would make no repayments on it. And if an opportunity came up, they'd just strike because they had the cash there available. So I think everyone should always keep a little bit of money on the side.
Yeah, I agree with that. And I think the most important thing about the emergency fund is about trying to make that number your new zero. So let's say, for argument's sake, your emergency fund is you set it to be 10 grand. Your account should never fall below 10 grand. If it is, then it means that it's a dire straits emergency and something has gone really wrong. And you should be trying to focus all your attention of getting it above that number and only working and planning with whatever above that number is. So it's about having that as kind of your new zero that you operate from moving forwards.
Yeah, excellent.
Yeah, there was a study done recently, and I've had a lot of commentary on the radio and media recently that people just don't think about this stuff. They're living month to month. There's more people that are living month to month than ever, and people are earning good money. So imagine what happens if the worst does happen and you don't have an emergency fund.
What was the old saying, for a rainy day? Or how did that go? I can't remember how it went.
Yeah, you've got to
save
put money,
for a rainy
save
day.
for a rainy day. I don't know about that, but save for if the wheels fall off, I say.
Hello, Nonna.
Nonna Panetta.
She's here every week. Maybe she needs to win the prize.
Yeah, she's our biggest fan. She's the original fan. She's the OG fan. Nonna, we're going to give you a signed copy of the book as well.
There you go, Nonna. There you go. All right. So, next question. We received that from a client of mine this week, and they've asked, is now a good time to buy property? So I really like this question, right? I really like this question. I think all the time is a good time to buy property if you can afford it. So typically when you're investing in property, you're taking on debt. So essentially, I believe you should buy property when you've saved up enough money or you've got the equity to buy it and you have the cash flow to support the debt, and ignore the macro, the outside environment. You just make sure that you buy a really good asset and accumulate as much as you can over time. I say often, right, if someone is 50 years old or 60 years old and they bought a property every 10 years for the past 5 cycles, so they accumulated 5 properties over 50 years, and every single time they stuffed it up and they bought the property at the wrong time of the cycle every single time, they're a multimillionaire. So they've still done all right. The other side of the flip side of that is people, especially in Sydney over the past 5 years, they didn't want to buy property because property markets were going up. So they said, I'm not going to buy any property because property is going up. The market's changed. It's 12 months ago, and especially over the past 6 months, the prices of property have started to go down. And those same people who didn't want to buy property when the market was going up are now saying, well, markets are going down, I don't want to buy any property. So they end up just never buying any property. So is now a good time to buy property? If you can afford it and it's part of your strategy, I think so.
Yeah, I think there needs to be an extension to this question, and it's about the reason why you're looking to buy property. I was having a conversation with a client today, and we were talking about whether they should buy their dream home and whether they can afford to buy their dream home, or whether the property that they're looking to buy is just a stepping stone in pursuit of their dream home. So if it is the latter, if it is a stepping stone, we need to be mindful that whenever you buy a property, there's a significant cost associated with that acquisition. We've got around about 4% for stamp duty, obviously all of the costs associated with moving in, and all of these things obviously push us actual backwards. So the property needs to do a certain amount of growth in order just to get us back to square. So if the market is in a position where in the short term, it's not going to provide us with the growth opportunities to use it as a positive stepping stone to push ourselves forwards, then we need to make sure that we're buying the property for the right reason. There's a big difference between using property as an investment or using property to facilitate a lifestyle objective. And I think this is far too often people get this wrong, right, Sam?
Correct. We see that all the time. You know, if someone wants to buy their home in a year's time or something like that, and they say, why don't I buy an investment property now and sell it in 12 months' time and it'll go up and I'll make heaps of money? It doesn't really work like that. First of all, property is still a growth asset. So you don't know whether it's going to go up, down or sideways in the short term. We know that over long periods of time, property in countries like Australia do really well. But in 12 months, that's too short of a period. The price of the property could drop considerably, could go nowhere. Yeah. And as Jackson mentioned, it's expensive to get in and out of real estate. You know, you got to pay the stamp duty, you got to pay the sales fees. If you make any money, you got to pay taxes. So it's one of those things. You need a strategy if you're gonna sink $500,000 into something.
All right, we had a question from Ken. This is for you, Sam.
To Sam, what lullaby do you sing your baby to sleep? None, mate. I don't know any lullabies. I've never sung to my daughter.
I don't think you should, mate.
Yeah, look,
I don't think you should. I've heard you sing. Although it says on your website that you're an award-winning vocalist, I don't think that it's a good idea that you sing.
Someone built my website and they wrote that I was an award-winning vocalist. I tell you, I'm not an award-winning vocalist.
Someone's taken the mickey out of Sam.
Yeah, sorry, Ken. I haven't sung any lullabies, mate. I'm sure no one wants to hear me sing a lullaby, not even my daughter. I don't know. She just goes to sleep. I don't know. My wife, she's all over it. She's all over it.
Lisa's on top of it.
All right. It's funny how Aureus Financial is thumbs up and is laughing faces.
It's just everyone's laughing at you, mate. Our whole team, our entire team across the world is laughing.
You guys are ruthless. Hello, Amanda. Thanks for the support. If you're sitting there, ask us a question.
It's all the questions.
All the questions. All right, mate, you're up next.
All right. So my boss wants me to go self-employed and continue working for him. Any advice? This is a really interesting question, and it's something that we see a lot in the trades. Particularly in things like construction and carpentry and form work and these types of things. And look, it's a really grey area, and in a lot of cases, it actually shouldn't happen. For you to go self-employed and contract or subcontract, you need to be producing at least 15% of your employment from somebody else. Otherwise, you should not have to forfeit all of the benefits associated with you being an employee. Things like the protection and security, the sick leave, the annual leave, the workers' compensation, all of these types of benefits that you have as an employee, you shouldn't have to forfeit those. Now, firstly, if you feel you're in that situation where you've been strong-armed into being self-employed and you don't want to be self-employed, jump onto the ATO website and there is a calculator that asks you a series of questions. It's not going to incriminate you. It doesn't ask for what's your boss's name, where does he live. It's a series of questions to help you understand your rights. And it basically goes through those questions and it tells you whether you should actually be an employee or whether you're actually justified being a contractor or being self-employed. Now, with saying that, as you've heard Sam and I talk about a lot, it is one of the biggest opportunities to be a business owner, to be self-employed. There is no other way that you can have a direct impact on how much income you can earn and the amount of wealth that you can create. So therefore, if you've been put into this situation, potentially forced into this situation, it can be seen as an opportunity if you choose to take it. So first things first is go and find out your rights. If you are doing 100% of your work with your current boss, then you need to bring it to their attention that you do have the right and you're actually obligated to go and find work alternatively elsewhere. and essentially start broadening your horizons. Build a bit of a plan around your business. Look for opportunities for you to increase your income, to be able to subsidize the lost security associated with being an employee, and take this thing real serious and look at how you can grow and build yourself up to running a successful business that allows you to build a team, to be able to grow your empire and achieve your personal goals. Once again, this depends on your perspective. Do you feel like you've been forced into it against your will? Or is this potentially an opportunity that you would like to be working towards to be able to control your own destiny and be self-employed?
Yeah, I think you're absolutely right there, mate. It's all about what your longer term goals are. I tell you, I probably wouldn't suggest going from an employee to being self-employed to earn the same amount of money. Why put yourself at the risk and lose all the security if you're not going to earn more money? If you're going to be in business and you're going to have all the responsibility that comes with being a business owner, you want to make sure that you're being well compensated for the risk that you're taking.
Yep, great question. Now, we've got a really good question here from Paul. So Paul says, hey guys, I live in Brisbane and I've got an investment property in Melbourne. I've heard that if you live in the property for a period of time, every 6 years, you don't have to pay for stamp duty. Is that correct? How long do you have to live there? So Paul, I think that might be around capital gains tax. And you're right. So the rule basically is that you can have one single principal place of residence, and you have the ability to change that principal place of residence every financial year for the purposes of taxation. Now, the rule is basically that you have the ability to have a principal place of residence, which is then transitioned to being an investment property. And if you hold that property and sell it within the 6 years of that being an investment, then you don't have to pay capital gains tax on that property. Now, the thing is here that it does get a little bit tricky if it was an investment first and then you live in it. The ruling from the ATO's perspective is that it is a principal place of residence first and then rent it out. So it's something that you need to make sure that you build a little bit of the timeline around. Funnily enough, I was talking to a client about this type of situation before because they're looking to sell a property that was their principal place of residence, transitioned into being an investment property, and we're approaching the 6-year mark now. So we're currently in the process of working with a sales agent to sell it. And we spoke about, well, okay, is this something that we're potentially going to look to do for the next property that they look to buy? And it's really just about trying to build a timeline. Now, Paul, I understand that you've got a few investment properties, mate. So it's about, once again, you need to build a business case, given that your properties are in different locations to where you live. It may be very difficult for you to substantiate a solid story that the ATO is going to be able to believe for you to minimise your tax. It's not impossible, but once again, we would have to be doing it for the right reasons. And in saying that, we've got to assess the opportunity cost. Does it make sense for you to uproot your life, go live in your investment property, find a new job or start a new business just to save some tax? I'd probably say that there's better things that you can be investing your time into. In saying that, I've had clients that have had a number of properties that have been in a single area, and then we've strategically changed which one was the principal place of residence to assist with taxation later on down the track. But once again, this is very complex stuff, so it pays to get good advice.
And I think it's a timely question, right? Because a lot of people, when it comes to tax, they do whatever they're going to do, and then they try to work out how to minimise tax at the end of it. We're going on a big push this month, being June, end of the financial year. We're saying to people, well, don't wait until the end of the financial year and then try to sort your tax out. Be proactive, get everything in place over the next couple of weeks, because you're going to have a much easier and a much more effective result of minimising your tax, and then plan out your next 12 months or 5 years or depending on what sort of vehicle it is, and you're going to get a much better result rather than doing whatever you're going to do and then trying to scramble right at the end.
100%. Yep, so hopefully that helps you out, mate.
Thanks, Paul.
Now, I had a question here from Michael Shaw. Have you done your CPD points yet? For those of you who aren't in the financial services industry, CPD stands for Continued Professional Development. As advisors, we have to complete, depending on your level of qualification, anywhere between 30 hours and 60 hours of professional development every financial year. Michael, I am working on it. I'm on the tail end of my MBA, and I'm also catching up on my last few points to make sure that we get that all locked away before the 30th of June, mate. So, hey, mate, if you're over your CPD points, how about you gift us a few?
Get up in Michael. Don't let him get away with it. All right. So for everyone who's watching, if you have any questions, don't be shy. Throw them out at us. We're here to answer them. We're just trying to add value to guys. Oh, hello, Rita. It's my cousin. Hello.
G'day, Rita.
Rita, you got any questions for us? Throw them out. Don't be shy. Thanks for the support. All right. So this is a question I get all the time at the moment. It's like it comes up every single week on Ask Aureus anything. And so here we go again. If people are asking it every single week, it means that it's important. It's on people's minds. So we're gonna answer it again. So we've received from one of my clients this week. It is really hard to borrow money at the moment. Should I just give up? No, you shouldn't just give up. You should never just give up on anything in life, especially when it's something financial, because there's always a way to work it out. You know, it's always been done before you. Unless you're the richest person on earth, someone else has already achieved what you're looking to achieve. In saying that, yes, it is really hard to borrow money at the moment. It's the hardest it's ever been for years, probably since back in the GFC. So don't feel alone. Today, if you're trying to buy a home, or if you're trying to buy an investment property and you're not being able to borrow as much as you want, or the banks are knocking you back, you're not alone. This is a common theme throughout the environment these days. With that being said, and let's say you want to achieve something, you want to buy your property. Let's work it out. Let's say if it's the deposit that's holding you back, put a savings plan in place. Do you know what I mean? Work out how much you need to save every week to get to your goal in X amount of months. If it's income that's holding you back and you're a PAYG employee, go study some more, work some overtime, earn some commissions, work out ways that you can earn extra money. So when you go back to the bank in 6 months or in 3 months, you can show that you're earning more money. If you're a business person and you're struggling to borrow money, same deal, try save more, push the business a little bit harder. And then while you're doing that, the business is going to be performing better, paying you a bigger salary, and also posting bigger profits. And the banks are going to see that, and they're going to want to throw more money at you. Typically, we see people react to being knocked back by the bank in two ways. Either they go, that's it, I'm never buying a property, or I'm never going to invest again, and they walk away with their tail between their legs. We've got other clients that, it was hard 12 months ago to borrow money, and we said to them, this financial year, you need to go hard. You need to show this much profit. You need to save this much money. It's the end of this financial year now, and they're coming back to us and they're going, mate, I've saved 100 grand or 50 grand or 150 grand. They're saying, the business made 200 grand this year or made 250 grand, and they've absolutely shot the lights out because they've had a goal, they've stuck to it, they've built a strategy, and they've achieved the goals that they've set out. And that's what we want to see, and that's why we're sitting here helping people, because that's what you should do if money is stopping you from achieving something in life.
Yeah, I think the important part of this is that there's people who have dreams and there's people who have goals. And I think it's about trying to be empowered to know what you need to do in order to achieve your kind of dream life, right? And it's about defining the destination, reverse engineering that into a plan, and then giving yourself either the ability to stick the path and work towards making that goal a reality, or not being able to stick it out and finding another way, either taking longer or reducing your expectations. So imagine this, let's put this into perspective. Let's say you came and sat down with Sam and I, and you're currently earning $80,000. And we did a lending scenario, and we say, hey, look, the bank isn't going to lend you enough money for you to be able to buy the property you want unless you're earning $100,000. So think about it. What are you going to be able to do right now to increase your earnings from that 80 to 100,000? Are you going to be defeated and say, no, there's absolutely no way that I'm ever going to be able to work up to that goal? Or are you going to say, game on, let's go try and find a way. I'm going to go back to my boss and I'm going to have a conversation about how I can add more value to the business. As Sam said, go back and do some study to be able to get a higher role that allows you to earn that much money. Get a side hustle that you can make some extra cash on the side, driving Uber or whatever, tutoring, whatever you may be able to do to add value to somebody else in exchange for money. And you would be very, very surprised how quickly you'll find a way to bridge that gap.
Mm-hmm.
There's two types of people, as Sam said. There's people who find a way, and there's people who find an excuse. Which one are you going to be?
Yeah, so that question got really emotional and really motivational. So you're all welcome. You're all welcome. Henry, thank you, mates. I'm glad you're enjoying it. I hope it's all rubbing off. You know, my friend Billy.
Yeah.
That's Billy's younger brother.
Yeah, guys.
So thanks, guys. Rita, thank you. Julian, thank you.
And
Antonio,
this is
your
my father-in-law.
Hello, Antonio. How do we say it in Portuguese, man?
I have absolutely no idea.
Ciao.
G'day.
Hello from
all
Australia.
the way from Brazil. So we've got fans all over the world.
Young Salvatore Michelli here. So Sal's lucky, right? So Jackson and I have been at this for years. So Sal's come in under our wing, and we're teaching him everything that he's got, and he's got his whole life mapped out. He knows what he wants out of life and how he's going to achieve it. And he's only, in his sort of mid-20s, so that is a very, very good head start in life. Good work, young Sal.
Big Sal Michelli.
So any questions, guys? Put them up. Don't be shy.
All right. So what do we got here? So I'm 2 years behind in my tax. Should I be concerned, and how do I fix this? So a very timely question. And look, this is typically, there's people in two boats here. I should say three. The first boat is you're a PAYG and you're actually going to get a refund from the ATO. Why haven't you done your tax return? Just go do them and get the cash in the bank. The ATO is never going to knock on your door and tell you if they owe you money. They only knock on your door if you owe them money. So the other two are, you're a PAYG, you've underestimated your tax withholding, and you're going to have to pay the tax man. And then the third one is that you're a business owner or a contractor or sole trader, and you're behind in your tax returns. Now, it's very important to understand that the ATO for quite a long while hasn't had the resources to aggressively chase people who owe tax. But they've recently ramped this up, and they're trying to set a precedent, given that the government wants to get the budget back to a surplus, and a very good way to do that is collect taxes. So what that means is that they're going to be very, very aggressive in chasing people that do have outstanding tax debts, who have outstanding tax returns that they suspect owe the money. So what you need to do is you need to get a good quality accountant, somebody who is able to help you think strategically, not just do the transaction and lodge the tax return, because it's not just about getting your tax returns done, it's about formulating a plan that'll help you get back on track. Now, the ATO is not some big bad beast that is going to throw you in jail, do the crocodile Dundee on you, unless you owe millions and millions of dollars in tax and are trying to avoid them. If so, they'll throw the book at you. But look, if you're in a bit of a tough situation, you're trying to get back on track, you're being honest, you're being proactive, the ATO will work with you to set up a payment plan to allow you to pay that back over time. And typically they will charge a rate of interest for that of around about 8%, but at least it is better than them taking you to court or throwing you in jail. Now, this is the thing. You just need to get on top of it, because it's so, disruptive to you and your overall financial plan without having tax returns. Particularly if we go back to that previous question about lending. You think lending's tough. There's absolutely no way you're going to go and borrow money if you don't have your tax returns up to date, or if you have a significant outstanding tax debt. Because the bank is going to not want to borrow you, because if you can't pay the tax man, how are you going to pay them? So it's important that if you are looking to build wealth, tax is just going to be a consequence of building wealth. So get on top of it, get good representation, get the right accountant that's going to support you, not just in submitting tax returns, but also coaching you to make sure that you can have a plan in place to make sure that you're always up to date with your tax.
It's one of those things, mate, and this is it pisses me off a little bit, right? So a lot of these small business owners get into heaps of trouble with tax. They don't understand the way money functions that you should as a business owner. They think if they earn $100 or $1,000 that they get to keep that $1,000. That's completely untrue. They need to pay the tax man. They need to pay GST. There's all sorts of costs that your typical small business owner just doesn't factor in. They get 12 months or 2 years into business. They realize they've got this massive outstanding tax debt, and they nearly go to the brink of collapse because they just haven't factored it in. And that's why I get really not anxious. I get really passionate about it. Is that if you're going to be in business, you need to take it seriously, because I've seen it cripple families having an outstanding tax debt. You know, there's other people that are excited every year for tax time. Like myself, I get excited every year. It's tax time. Go, you show them your tax return, you get them done, you go back to the bank lends you more money, you buy more property. Beautiful time. But you have to treat it like that. You know what I mean? You have to be on the front foot. Otherwise, you're always going to be behind in your tax. And if you're behind in your tax, there's probably other parts of your financial life that are a bit of a mess as well. You probably don't have your budget in place. Your superannuation's probably in a dog fund, and you're getting ripped off with insurances and things like that. So it's it's one of those things. How you do one thing is how you do everything.
Yep. Love that. All right.
Looking and sounding very professional. That's good.
Good.
That's my Uncle Sam. Jackson was confused because
I was just nearly confused again. I thought you were commenting on our own Q&A. Sorry, Uncle Sam.
My Uncle Sam comment. Jackson didn't know if it was me or my uncle. He was very stressed about the whole thing.
That's all right.
So anyone else sitting there, you got any questions? Feel free to throw them out. This is something I got this week from a client of mine. How do you choose the right loan for me? It's an excellent question, and most bankers and most mortgage brokers, when you ask them that, they don't know, because they don't have a strategy, they don't have a system, they don't have a process. They're essentially just winging it, hoping they can write a loan and make a little bit of commission. So I have a 3-tiered process. So number one, and the most important thing, is the strategy. So where can we get this deal to work? All right. Now, to contrary belief, most banks or most clients can't go to every single bank. All right, you have to be a very strong applicant to be able to go to any bank you want. Most clients fit in with half a dozen banks or less. All right, so that's the first thing that you do, is eliminate everywhere where the deal is not going to work. Okay. Secondly to that, out of those lenders where the deal will work, you want to structure it correctly and you want to price it correctly. So you want to make sure that, is it going to be fixed or variable? Is it going to be owner occupied or investment? Is it going to be principal and interest or interest only repayments? And then from there, once you've worked out the structure, you can go in, negotiate hard with the lenders to make sure that you're getting the best price. All right, so that's stage 2. Price comes second. The ads on the TV are not going to tell you that. They sell you the dream that price comes first. In reality, especially if you're growing wealth, that's not the case. And stage 3, step 3, is out of those 6 lenders, let's say that the deal will work, and 3 of them are the most competitive. You go into those 3 banks and you say, okay, where are we going to get the fastest turnaround times for you? Or where are we going to have the best service post-settlement? So these are the softer things. Who's got the best banking app on their phone, right? If they're all priced pretty similarly, take the bank that's going to give you the best service post-settlement, all right? And that's how you choose lenders. And it doesn't have to be more confusing than that, but a lot of the finance industry complicates it more than it needs to be.
And I think the average person doesn't understand this. You don't know what you don't know. It's like us with audio visual. We had absolutely no idea. Even the other day, I bought all of this crap that didn't even work, and I had to send it back. And when it comes to audio visual, that's all right. You can chuck it in a return envelope and send it back. When it comes to your financial well-being and your wealth strategy, you've only got a couple of shots at this. There's only a couple of applications that you can make before your credit file is cooked, and another bank won't look at you if the other ones have turned you away. So it's very important that you have the right person to represent you that understands the dynamics of the lending environment, because it is constantly changing, right, Sam?
It is all the time, and it's going to continue changing for the foreseeable future. Now, there's going to come a point where it eases up again. It's the cycle, it's the nature of finance. but that's not in sight at the moment. It's going to continue getting more difficult. And despite everything that's going on with the Royal Commission and the banks are bashing brokers, brokers are still a structurally better way of getting finance. You have to think, if a bank, you go to the bank, you've only got their options. You go to a broker, you've got 50 options or 60 options. And that's the key thing. So no matter what goes on with this Royal Commission, we've seen that 20 years ago, brokers didn't exist. 10 years ago, they had 20% market share. Today, they got 55% market share. Go to a more established market like in England, and they're up there with like 80% market share. Wow. So it's just a better way of securing finance.
Yeah. Cool. All right. So I'm a newbie in business. Can you give me a checklist of things I should be doing before tax time? Great question. So when it comes to being in business, it depends on your stage of business. And although I think one of the biggest things that I try and convince all of my clients to do very early in the piece, if not immediately, is get a good accounting system like Xero. As a business owner, you need to understand the value of your time. And particularly when you're getting started, we've seen businesses do 400, 800, even 4,000% growth in their first year just because they've invested their time appropriately. So you've got to think about it. In the first instance, if you're trying to whinge about a $30 or $50 subscription for a piece of software, and you think that you're going to be able to keep all your receipts and do all your own bookkeeping, lodge your own BAS statements, do your own tax return, you're kidding yourself. You need to put a dollar value on your time. And wherever possible, you stick to what you know and you outsource everything else. So the best advice I can give you is get a good piece of accounting system like Xero. Make sure you've got your business bank account set up so everything can be pretty much automated and you can keep really good records of all of your incomings and outgoings. And make sure that you are essentially optimizing all of your expenses and looking for opportunities where you can, maximize your deductions with being mindful of your strategy for this tax year. Coming back to the previous point, a lot of this comes back to lending. Tax and lending as a business owner are probably the two most significant things to you continuing to build wealth. So minimizing tax is actually reducing your borrowing capacity. So what I would be advocating that you do is before tax time, if you're looking to buy property over the next 12 months, speak to a mortgage broker and understand how much income you need to show on your financials to allow you to be able to buy the property that you want. Otherwise, if tax time's done and dusted, there's only so much that can be done to kind of impact the final outcome. Further to that, get a really good quality accountant. You should have the right people on your team to support you, not just looking backwards, given that tax is really backwards looking, it's looking back in history, but looking forwards of what you're looking to do moving forward strategically to grow your business, to grow your wealth, and to achieve your lifestyle objectives. And we're talking to a new prospective client yesterday. He's starting a new business. We gave him a bit of crash course on what he should be doing. And when it comes down, he goes, yeah, I want to grow my business. I want to scale. I want to get people on board. But then I want to get into a role where I can stop trading time for money and start living the lifestyle that I want. So I think tax, once again, is just a consequence of making money. It is what it is. Optimize it where you can. But use this time to start thinking about what you want to be doing over the next 12 months and start building a plan. So then you can obviously utilize your business and obviously as a consequence, the tax you pay as a way of creating the life that you desire.
Yeah, it's great advice. And for everyone who's watching, who's a part of the Wealth Mentor community, we actually uploaded a cheat sheet that we put together maybe a week or so ago at the start of the month. Jump on there and grab it. Go and grab it. It's got like a dozen hints and tips for tax time, so you can get the most out of it.
It's even got a cartoon of me.
Does it?
It does.
It's even got a cartoon of Jackson on it.
So top knot and everything.
So there's some good value there. But look, jump on. If you're not a part of the community, it is gated, but we will let you in if you ask. Go in there and grab it. It's just free value. I don't know why you wouldn't take it.
Yeah, there's no hazing ceremony or anything to get in. It's good, clean and wholesome in that community.
All right, for anyone who's watching, if you have any questions, make sure to ask us. We'll answer the live questions as a priority, guys. All right, so This comes from, this is something that we're seeing a lot of at the moment. So I can't borrow quite enough money from the bank for my next investment property. Should I start to diversify? I love this. I love this question, right? And I get it all the time now because people were making a lot of money out of the Sydney and Melbourne property markets over the past 5 years. And it was a very easy bet to just borrow as much as you can. The banks would give you the money, buy investment properties, and the market was just booming 10, 20% every year. So it was a lot of people created a whole lot of wealth over the past 5 years. The game's changed. That game doesn't work anymore. And all those people who were very ambitious and took on a lot of debt, the banks aren't going to give them any more debt. They're capped out for now, unless they can get their careers or their businesses cranking and making heaps of money. So with that being the case, I think you should start to diversify. And there's essentially 3 pillars that you can invest in when you're considering investing. There's obviously real estate. There's business. If you're a business owner, is to grow your business. And if you're not a business owner, or even if you are, there's managed funds or equities or in the share market, whatever you want to call it. And that is a very simple way to diversify outside of your business, outside of property. And you don't need to borrow to invest in managed funds. You can, if you have a surplus income of $2,000 a month or $3,000 a month or $1,000 a month, you can sink that money into the market, accumulate shares over time. And if you treat it like you treat property and hold for the long term, you're going to do well out of it. So a lot of people, they don't want to diversify out of property, but they don't have a choice. What they don't understand is the game's changed. And if you're not pumping your business, then you have to put your money somewhere else, because money in a bank account earning 1.5% is not going to even outperform inflation. So you're going to slowly go backwards.
Yeah, I think it's really important to build a well-rounded portfolio. We call it a core satellite approach, where the core of your portfolio should always be property, because it's relatively secure if you're buying in good areas. We can use leverage to be able to maximize the return on our initial investment, and essentially gives us some kind of comfort given that it's a physical asset. But it has its downsides. It's illiquid. We can't sell the kitchen sink if we want to go to the Bahamas. We essentially have issues around the cost of maintaining those properties, the potential risks associated with tenants trashing the place. These are real problems. So we want to try and implement a well-rounded and diversified strategy. And for the satellite part of your strategy, you should be looking for opportunities to have liquid investments that give us a wide array of diversification, that give us the ability to drip feed money into the market over time, and just let the investment strategy run itself. We've got to understand that there's a lot of time and effort that goes into finding the right property, negotiating on it, settling on it, maintaining it. But when it comes to investing in, let's say, an investment portfolio of index funds, managed funds, or exchange-traded funds, particularly if they are pre-mixed or diversified funds that give us exposure to the whole world, it's very, very easy. All we need to do is just select the right fund and then put money into the market. To go into a little bit more detail about how you can do that, you can essentially go and set up some type of trading platform. As we've spoken about before, we don't really advocate that our clients go and buy direct equities. It's very difficult, and it's basically it's a science to understand how to select companies that have real intrinsic value and the fundamentals to perform over time. So therefore, if you are not a trader, you do not have the skills to trade, then you should be looking for a diversified approach. So there are exchange-traded funds, which is basically like an index fund that you can buy, and it gives us exposure over a wide variety of countries, asset classes. So that's typically a way to do it. Alternatively, there are some micro investment apps that are out there that are quite good, that gives you the same type of approach. Or essentially, we set up a platform for our clients. We provide them with advice around how much they should be putting in, and we essentially manage that on their behalf by selecting those same investments, but essentially we give them the oversight and we manage it for them to make best use of their time.
And I think it's really important, because when people think of the stock market, right, they think of like 1980s Wall Street, of guys like screaming at each other on a trading floor. That's not how you invest in the stock market. Do you know what I mean? You need to, if you want to be manic and treat it like that and treat it like it's Crown Casino, go right ahead. We're not going to be involved with that at all. But if you treat it as an investment to grow wealth over the long term, that's what it's going to do. So for most people, it's a mentality thing that they need to change the way they see it.
It's all about getting educated. Well,
Mm.
we've got great content that's going to be coming out shortly that's going to help educate you around all of these things. So yeah, stay tuned. If this is something that you're interested in, reach out to us. We're more than happy to give you some more detailed insights.
Excellent stuff.
All right. So those of you who are watching, if you've got any questions, please make sure you post. We will prioritise those live. But in any case, I'm young and I'm considering contributing more to super. Is it worth chucking in a lump sum? Very interesting question. And for young clients, it's very rare that I get people asking about whether they should be chucking big lump sums into super. But it's a good question. Now, when I look at this and I explain this to my clients, we all have a bucket strategy. And there's 3 buckets that we need to consider. There is a short-term bucket, which is 0 to 1 year. We've got a medium-term bucket, which is 1 year until you turn age 60. And then the long-term bucket is 60 plus. The reason why is because the long-term bucket is our super. And under the current rules and legislation, if you retire at 60, you can access your super tax-free from then onwards. So we need to understand that there's no other way that we can invest that's tax-free right now. So essentially, as soon as you're earning over 18 grand a year, you're paying tax. So we need to understand that's the most tax-effective way for us to save for the future, but we can't access it until we're 60. So this complicates things a little. The reason why we have the bucket strategy is your money should flow from your income into the short-term bucket, from the short-term bucket into the medium term into the long term. So you first need to define, have you achieved your short and medium term goals, or are there other things that you need to prioritize to ensure that you can have some level of, of comfort before retirement? Because harsh reality is some of us might not get there. And then consider what we should be putting into super. Now, in saying that, for many of our clients, we do recommend that they just increase their contribution by an amount per week or per month, or increase the percentage from 9.5 to something else, which is a very small additional contribution that they're making. But over time, it makes a very big difference. If you're going to look to make a lump sum, the question needs to be, is there anything else that you could be better using that money for that's going to allow you to push your wealth forwards, that's going to allow you to have more benefit between now and 60? If the answer is yes, then we need to assess that opportunity. If the answer is no, then by all means, consider putting more money into super. Being mindful that there is a limitation to how much you can put in. So a pre-tax deductible contribution is a maximum of $25,000 per annum, including what your employer's putting in. And I would be saying that would be the wisest choice, given that it's the most tax optimal outcome. The other one is what's called a non-concessional contribution, or an after-tax contribution. There's better ways to be putting money away. That's really a kind of a last resort, that you've got money laying around that you can't find anything better to do with. Then that's when we consider looking at that option. But once again, this is about your situation and assessing whether you have your strategy in order for the short, medium, and long term first.
And I know the client who asked this question, and she's the top 1%. Let me tell you, she's young, she works hard, she saves her money, she invests, she's absolutely all over it. Everything that you have to do right with money, she does. So I know, no doubt, she doesn't have to do anything spectacular over the next 10 or 20 years, and she's going to be a multi-millionaire, this particular client who asked this question. What most people, when it comes to superannuation, forget about the sexy stuff, SMSFs, forget about additional contributions. Most people don't get the basics right. They don't get their fund that's performing. They get it. They don't know where their super is. They got 10 super funds. It's just a mess. It's getting eaten away in fees. So for most people, for 90% of you, it's more about getting the basics right. And then once you've got the basics right, you can start asking these better questions. But if you haven't ever done anything with your super, I'm telling you, your super's a mess. So take those wise words.
Yep. Yeah. Reassess it. We can help you do a bit of a comparison if that's something that you would like. Help you wrap it all up and consolidate it and make sure that it's invested appropriately. Because it's one of the biggest and most significant things that you can do for your retirement savings is ensuring that you have your investments allocated correctly.
All right, excellent stuff. Anyone who's watching, got any questions, do not be shy. Feel free to ask away. All right, so here's a question we received last week. So I'm about to retire and have several properties, but also quite a lot of debt. I maintain the debt, but I'm unsure if I should keep or sell the properties. Thoughts? Look, I like this, and this is a good problem to have. You know, someone who's near retirement, they've worked hard, they've accumulated a number of investment properties. When it comes to investment properties, they've accumulated a lot of debt as well. If they've bought those properties over a long period of time, the loan to value ratio is probably pretty low. So, you know, if they've got $4 million worth of property, they've probably only got $2 million worth of debt or something similar. I think when you're in that situation, you need to ask yourself, how much income am I going to need to live the lifestyle I desire in retirement? As Jackson said before, with residential real estate, great for growth. You can't sell the kitchen sink to go on a holiday. It's a big lumpy asset. Yes, you can collect rent from a property. Typically, property doesn't yield a great deal. It's not a great yielding investment, and there are costs associated with holding properties. You need to pay your property manager, you need to pay insurances, you need to pay for repairs and maintenance. And you know, if you're holding a property for 10, 20 or 30 years, if you're retiring at 60, holding it until 80 or 90, that's going to be a very old property at that stage, and it's going to need money thrown at it. So what a lot of people do is they sell down whatever property they need to, pay off all the debt and collect the rent. Or some people take it a little bit of a step further, or they'll sell down other properties, keep some of the debt, put some of the cash into like high yielding managed funds. Some people will sell all the property, put it into super, put it into managed funds that yield more. Some will sell residential real estate and buy commercial real estate. I think when you're at that stage and you've created wealth, you really need to ask yourself, how much income do I need? Yeah. And then how am I going to achieve that income? I know it's not a very good answer, and it's a grey answer because it's a very complex subject.
Yeah, there's two parts to this. There's the tax and there's the income requirements. Because in retirement, the only thing that you should be caring about is your ability to maintain an income to allow you to choose how you spend the rest of your time. And the other big thing is about how do you optimize your tax to keep more money in your pocket and less money in the tax man's pocket. So this kind of links back to that previous question about super. Once again, long-term bucket 60 plus, and the current rules, as long as you have under $1.6 million per member or per person. So for a household, you have the ability to have $3.2 million of tax-free income or tax-free wealth in retirement, which will last you for a very long time depending on your income expectancy. So what we need to look at doing is typically, and I expect from this question that the properties are owned in your own name, it's about saying, okay, depending on your age, how can we get as much of that money into a tax-free environment as we possibly can? This is where that point that I raised before around the after-tax contributions come into effect. This is where we potentially sell down some properties, pay down the debt, pay the tax, and then contribute that money after tax into superannuation, and then essentially have it in a tax-free environment potentially for 30 or 40 years working for us. And there's plenty of clients that we reacquire property inside superannuation, as Sam said, potentially commercial property because of its high income, to be able to provide you with a lifestyle that you retire. Because once again, if we're taking the same level of risk, just because of that tax saving that in your own name you might be paying on average 30% tax, we can, if we want to get match the same level of income, we're increasing our earning capacity by 30% because we've removed the tax from the equation. So once again, it's about optimizing, but also understanding how much wealth you need to give you the income that you require.
And one of the things here is, and this is something we see a lot, is this has to be driven by your lifestyle ambitions and not your ego, right? So that's Big Sal's phone ringing. He's going to be in trouble.
Put on silent, Sal.
Big Sal. All right. So what I was saying is that you don't want to be driven by ego. We've seen so many people get to retirement and they live in these big $2-3 million homes, and they have these, expensive blocks of land with old houses on them that the investment property is worth $2.5 million. They get $700 a week rent out of it, and they don't want to sell because they've got such big egos that they want to be property owners and they want to own this property. That's no good to you. $700 a week in retirement where you could sell it and put a couple million in your pocket, take the couple of million and go to the Bahamas twice a year and relax. Do you know what I mean? So it's a complex space, but you want to make sure that in retirement you've got the funds to live. You've worked hard for 50 years. You don't want
exactly
to.
Right. Yeah. Look, I spoke to a client recently in a bit of a tough situation. House is pretty much paid off. but all of the equity's tied up in the house. And they're living pretty tough and living really a very, very basic life, just because they're not willing to come to terms with the fact that they need to sell their house if they want to improve their lifestyle. So what's more important? Living in the house that you've worked hard to pretty much pay off, but living a crappy life and not being able to do all the nice things with the rest of your time that you've got left, or going and selling everything and going and renting the best place and going on all the holidays that you want and doing everything that you want to live the rest of your life in the best fashion possible to reward you for all your hard work. You choose. I know what I'd prefer to do.
No, that's right. And look, a lot of people don't want to rent, right? They want to own their home. All right. Do you need a 5-bedroom home in the suburb? You live on your own. Do you really need a 2.5? Go sell it, buy a $500,000 unit down the road. You know what I mean? Spend $800 and get a nice renovated one. But you get the gist. You get the gist of it.
Yep.
For everyone who's watching, there's 5 minutes left. So if anyone has anything they want to ask us, now is your time to shoot, because we're going to be wrapping up in 5 minutes. Here's another question here for you, mate.
Cool. All right. So my father wants to give me a property. Is there anything I should be concerned of? Firstly, congratulations. That's fantastic. Your dad's a good man. And look, we need to understand a couple of things here. We look at this a couple of ways. We've had clients that have the ambition to want to buy properties for the purpose of gifting to their kids later on down the track. Great in theory, but there are some implications. So the first thing is it an investment property or is it the family home? If it is the family home, then the only consideration is stamp duty, on the basis that it is a deemed sale, so therefore it's transferring from one person to another. So stamp duty will need to be paid, which is circa around 4%, depending on the state. You can jump onto our website. We've got a stamp duty calculator and you can work that out. The other one is if it's an investment property, it is going to trigger capital gains tax at the deemable value of what it is worth at that particular point in time. So your father's going to be incurring and will be liable for that tax. So it's a matter of saying, okay, well, is it fair that you're gifting that? Although he's gifting you the property, I don't know if he's also going to pay the tax bill at the same time. So you may want to have a conversation. He may be a super good bloke and he's willing to do that as well. If so, you've struck goals, basically. But in any case, get some tax advice, work out a bit of a plan, formulate an agreement, and then essentially work out how that all works and who's responsible for paying what. So if that is the case, and you do have to be liable for some costs, then I would also be speaking to a mortgage broker as well, because you are going to be getting this asset. So you potentially have the ability to leverage against it, which maybe give you the ability to, once you've got that property, buy another property, or at least get a loan that's going to cover the costs associated with that transaction. So it isn't going to be a nil-all game. It's not that you're just going to transfer the property and everyone's going to go on their merry way. There are going to be some costs associated with that. You've got to be mindful of that. Further to that, you've also got to be mindful, and the question that I always ask, because it was brought up the other day in a conversation with a client, is that if your father is in retirement phase and is currently entitled to the age pension or some type of Centrelink benefit, this can have some significant implications for him. There are very small gifting provisions under Centrelink rules that they can only gift $30,000 over 5 years. So what this means is even though he's gifted it to you, Centrelink will still deem the income and the value of the asset for the purposes of his benefits, which could potentially have some implications in terms of that. So we need to understand the motivation. Once again, get some advice. This is very complex.
And I reckon there'd be a lot of people watching right now going, what's the problem? You're about to be gifted a home or a house or something like that. But what you have to understand is all the wealth that's accumulated by people, and there's a lot of wealth in Australia, it all has to be passed down eventually. It has to go somewhere, whether it's to your kids or to charity or to the church, it doesn't matter. But all the wealth that's created has to go somewhere. So we talk about the wealth pyramid, and once people go from battle to comfort, and then from comfort they start growing their wealth, and then they get to financial freedom, or they get to financial abundance where they have essentially more money than they need. That money needs to be managed, and it needs to be managed generationally as well. So it's not uncommon for people to be given homes or businesses or things like that. So you need to think, if you're young and you're working hard now to accumulate wealth, that one day you need to think about how you're going to hand it down in the most effective manner. And I know it's a long way in the future, but when you're talking millions, you could have hundreds of thousands of dollars just by what decision you make.
100%.
So it's not as simple as just throwing someone the keys. This is not big fat Greek wedding. That's not what it's about. So.
All right. Are we going to get time for the last question, or we're going to wrap it up?
Oh, let's do it. Let's go. Come on, guys.
We've got you back, mate. We don't know when you're going to be back again.
All right. So here's a question we received from one of our business clients. They said, I'm self-employed, but I find I spend more time running the day-to-day of my business than what I am good at. What should I outsource and why? This is a tricky question. So you should outsource, in simple terms, anything that someone else is better than you at, or anything that you don't enjoy. They're the two things I think you should outsource. Spending my day running the day-to-day of the business.
That's just part and parcel of being self-employed.
Yeah, you can't outsource the running of the business unless it's a really big business, and you're going to get a CEO in there and you're going to pay him $500,000 a year and you're going to say, hey mate, run the business. I'm going to Mexico. So yeah, I think you should start small with outsourcing. Outsource things that are methodical. Things that are systematic, that they can be repeated over and over again, something where you can, and we do heaps of it, where we go on, we film something that we're doing, we make a 5-minute video out of it, we turn it to the intranet, and then if someone says to me, oh, hey Sam, how do we do a servicing calculator with Commonwealth Bank? I say, well, go check out the video that I made on it. And now anyone can do a servicing calculator with Commonwealth Bank. If you want to do one at home, you ask me. I'll send you the video, and you can do it too. But start small, and if you really work your way up, then one day you can hire a CEO and you can go live the dream.
There's two parts to this. You stick to what you know and you outsource everything else, is my motto. And you need to understand that as a business owner, if you want to be a successful business owner, there's a number of transitions. You go from a technician to a manager, from a manager to a leader, and from a leader to an entrepreneur. So you need to, it seems like you're stuck between that technician and manager. You're managing the business, you want to get back to your craft of what you're good at, but you need to understand where you add the most value in your business. So once again, it's just about evaluating where you want to be, what you want to be doing, and how big you want to grow your empire.
And everyone in business goes through this, man. It's I go through it every day. Like, I love doing finance and I love writing home loans and all that, but I know that there's bigger things that we're doing at the moment, and I need to spearhead that. And I'm sort of torn, and that's why I finished work at 12:30 last night, because you're trying to do everything, and there comes a point where you have to let it go. But you don't want to let it go too early, because that's at the detriment of the business. It's a very fine balancing act, and I guess that's what determines the difference between someone who can continue to grow their business and someone who remains stagnant or even goes backwards.
Good point. Well,
Gary Alexander, can I go to Mexico with you, Sam?
Sam's not going to Mexico.
I'm not going to go to Mexico, mate. I'm never leaving Narrowena.
He's a simple boy from Narrowena. All right.
All right, guys.
All right, everyone. Well, this is another installment of our Ask Aureus Anything Live Q&A. If you do watch this once we've gone offline, please continue to put your questions up. We will put them on the list for next week. We hope you've got a lot of value, and we'll see you same place, same time.
See you guys next week.
Catch you later.